In today's episode, we'll break down two important stories. First, we'll talk about why Indian conglomerates are chasing fast fashion, and then we'll talk about the IMF having a grim outlook for the world. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. If you're listening to this on your commute, on a walk, or at the gym, you can also find the Daily Brief as an audio podcast on Spotify, Apple Podcasts, or wherever you listen to your podcasts. I'm your host, Akshara, and today is Monday, 27th April. Coming to the first story. So Trent, the Tata Group's retail arm, published its full year results last week. By March 31st, 2026, it was running 963 Zudio stores across India. So if you haven't been, Zudio sells t-shirts for Rs 399, jeans for under Rs 600, with 47 new cities entered in the last quarter alone and 80% of new stores in Tier 2 and Tier 3 cities. Now, Tata is not alone here. Reliance launched Yousta, where all products are priced below Rs 999 and most below Rs 499. ABFRL, the Aditya Birla fashion arm, launched Owned in September 2025, starting at Rs 399 and targeting Gen Z with 10,000 styles. And in April 2026, it hired a new CEO for it, Marco Agnolin, who previously ran Bershka and Diesel. So, three of India's largest conglomerates, companies whose combined reach spans oil refineries, steel mills, telecom networks, and cement plants, are in an active competition over the cheapest part of the wardrobe. The obvious answer is that young Indians want affordable clothes and the market is large. Now, that explains why the segment exists, but not why the Tatas and Ambanis are the ones winning it. There are plenty of younger, nimbler, more fashion-native companies that spotted the same demand. But fewer than 10% of the 700 plus D2C fashion brands operating in India have grown beyond Rs 50 crore in revenue. Most of them have not scaled. And the reason behind this might have nothing to do with fashion or taste. Now, fashion is structurally different from most consumer goods in one way that matters enormously at low price points. A shampoo company has a product. The formulation changes once a decade, and you forecast demand, manufacture, ship. If you overproduce, you discount. Nothing expires. This whole equation gets exponentially hard for a fashion retailer. So each permutation and combination of size, color, design, and trend is a new distinct item that can succeed or fail on its own terms. A store like Zudio might carry thousands of distinct items at any point. Every single one carries its own demand risk. A style can miss, a color can arrive out of season, the size ratio can be wrong, too many smalls, not enough mediums, and unlike shampoo, a fashion item has an expiry date that has nothing to do with chemistry. Last quarter's trending cargo pant is this quarter's markdown problem. At Rs 2,999 per piece, you can survive your own mistakes. Mark something down 30% and the store recovers something. The margin provides a buffer. At Rs 499, that buffer does not exist. A slow-moving 499 rupee item cannot be meaningfully discontinued. It's effectively a write-off. So the only way value fashion works is if you're right, which style, which color, which size, which city, how many units, most of the time, and you turn inventory fast enough to catch errors before they compound across 1,000 stores. Trend's own FY26 results statements say their disciplines around inventory provisioning was the business's operational drivers. The company also announced a Rs 2,500 crore rights issue, part of which is earmarked specifically for expanding and automating supply chain and warehousing. Now, India is one of the world's largest garment producers. The clusters in Tirupur, Surat, Ludhiana, and Bengaluru supply H&M, Gap, and Marks & Spencer. The industry is enormous, mature, and efficient. It's also almost entirely calibrated for the wrong customer. So India's garment manufacturing base was built around Western fashion buyers. Bulk orders, 4 to 6 month planning horizons, standardized international sizing, free onboard export contracts. That supply chain runs on lead times of 75 to 90 days from order to finished goods, fabric procurement, sample approval, bulk production, finishing, quality checks, documentation. The system is efficient for a customer who plans seasons far in advance and orders in large volumes. But domestic fast fashion, the kind Zudio, Yousta, and Owned want to operate, needs the exact opposite. Reliance's FY25 annual report says its apparel business runs a design to shelf cycle of 30 days. So, to go from a sketch to a Yousta store shelf in 30 days, you can't wait for fabric to be ordered after a design is confirmed. For that, Reliance needs raw materials pre positioned at vendors before the production decision is made, and manufacturers who can run small batches and pivot to a new style within days. A garment factory running on 90-day export cycles has its entire operation organized around that rhythm. Fabric procurement schedules, workforce planning, production line sequencing, quality check processes. Restructuring for 30-day domestic cycles means changing all of that, different raw material buffers, different production sequencing, different everything. A factory makes that investment only when a retailer can guarantee enough consistent purchase orders to recover the cost of retooling. That operating model, 30 days, small batches, Indian sizing, high style rotation, is not what Indian garment factories are used to doing. Which means that when Zudio or Yousta want to restock a trending item in week 3, they're calling a factory that was built for a completely different customer and asking it to work differently that fits their model. And the factory would only comply if they would get enough volumes and business from them. Now, Trent, with 963 stores and rupees 20,000 crore in annual revenue, can make that promise. Reliance Retail, with 19,340 stores and 349 million registered customers, can make that promise. A brand doing rupees 50 crore in annual revenue cannot. This is the moat that the category conversion consistently misses. The competitive advantage in value fashion at scale is purchase order volume required to get a manufacturer to change how it works and then sustain that relationship at the speed the business model needs. The private label structure of these businesses ties this together. Zudio, Yousta, and Owned are all entirely private label, every item designed, sourced, and sold by the retailer with no external brand names. At sub 500 rupee pricing, there's simply no margin to pay a third party for their name. So the retailer absorbs every function, designer, buyer, production manager, quality controller that traditional fashion distributes across the supply chain. That means the business is not just the retail store, but ownership of the complete supply chain, which is why Reliance describes its fashion operations as yarn to wardrobe, vertically integrated from fabric sourcing through design, production, and distribution. So when ABFRL needed someone to run Owned, it did not hire from Indian retail or Indian fashion. It hired Marco Agnolin, the man who previously ran Bershka, Inditex's youth fast fashion format with 854 stores across 68 markets, and before that, Diesel. He's someone who spent his career operating this machine at scale across dozens of countries. Tata, Reliance, and Birla are not in value fashion because they have better taste than smaller competitors. They're in it because value fashion at national scale is an industrial supply chain problem. And industrial supply chain problems are precisely what these companies can solve with their scale and their deep pockets. A Bain & Company study found that fewer than 10% of the 700 plus D2C fashion brands operating in India have scaled beyond rupees 50 crore in revenue. Most fashion native brands hit a wall, not because their product was wrong, but because they could not build the supply chain infrastructure that national scale requires. Which is exactly why the people who built India's steel plants, oil refineries, and telecom networks are the ones running it. If you prefer reading the daily brief instead of watching the video, check out the link to the newsletter in the description. Coming to the second story. Every April, the IMF releases its World Economic Outlook, or WEO, which is essentially an official report card on the global economy. The headline report is usually split up into 3 or 4 chapters, and the first chapter simply provides economic growth forecasts. This year's edition does the same for sure, but there's one major difference compared to past reports. See, most of the report is about war, whose incidence has risen pretty sharply compared to 4 decades ago. The WEO is not really a document known for dramatic language, but when the IMF bases most of its flagship publication on the impact of armed conflict, there couldn't be a bigger sign of how tense the times are currently. Between an oil crisis of magnitudes not seen in at least 5 decades and geopolitical tensions that underscore that crisis and other things beyond that, the world has its hands full. 2 of the 3 chapters in this year's WEO are entirely about the military turn in global politics. Chapter 2 studies what rearming costs an economy, and Chapter 3 studies what actual war costs. Together, they form something like an escalating argument. Spending, fighting, recovering, with each stage more economically damaging and harder to reverse than the one before. The findings in the first chapter will be obvious to anyone with even the smallest hint of the state of the world today, so we won't spend time going into those. Let's dive into what chapters 2 and 3 of the WEO say. Let's start with where most countries currently are, spending more on defense without yet fighting a war. The numbers are striking. Over the past 5 years, roughly half of all countries worldwide have raised their military budgets. As of 2024, nearly 40% of countries were spending more than 2% of GDP on defense, up from 27% in 2018. In June 2025, NATO members committed to raising defense and security spending to 5% of GDP by 2035, more than double the previous target. Arms sales by the world's largest 100 defense firms have, in real terms, doubled over 2 decades. Now, the intuitive assumption is that defense investments are as stimulative as any other. Governments spend money, factories hum, workers get hired, and there's economic growth. This is partly true, but the picture is messier. That's because defense spending doesn't work like other forms of government expenditure. So when a government builds a road or hires more teachers, the spending diffuses broadly through various stakeholders, like construction workers, local businesses, households, etc. But defense spending is too concentrated in a narrow set of industries to do that. Think aerospace, specialized materials, and transport equipment. So a military buildup functions less like a general demand stimulus and more like a targeted shock to a specific set of sectors. Workers and capital have to shift toward defense industries from wherever they currently sit, and that reallocation is slow, expensive, and often disruptive to the sectors losing resources. But the short-term effect might still be positive. The IMF finds that in peacetime, defense booms raise GDP by approximately 3% more than it would otherwise have been, while inflation rises briefly and then fades. Over longer horizons, if the spending is directed toward R&D, genuine productivity gains can follow. The internet, GPS, and much of modern semiconductor technology trace their origins to military R&D. But there are two substantial forces working against this. The first is the import leakage problem. Most countries don't make most of what they buy. Nearly 80% of the military equipment purchased by European Union member countries is imported. The United States alone accounts for nearly half of all revenue among the world's top 100 arms firms. So when, say, Poland buys fighter jets from the US or artillery systems from South Korea, which it has been doing at an extraordinary pace, the demand stimulus flows primarily to foreign producers. Poland bears the full fiscal cost of the purchase, and the economic benefit lands elsewhere. The second is what happens to the government's finances. A typical boom widens the fiscal deficit by about 2.6% of GDP and raises public debt by roughly 7% within 3 years. About 2/3 of defense buildups are financed by borrowing. So when higher public debt tightens financial conditions, as it often does, firms outside the defense sector find credit more expensive and private investment gets crowded out. The IMF's firm-level data shows this directly. During booms associated with rising public debt, firms become measurably more financially constrained and pull back on investment. The defense sector gains, but much of the rest of the economy loses. Now, when the financing comes from cutting other spending rather than borrowing, the trade-off is even starker. Health, education, and social protection fall by about 1% of GDP within 3 years. In wartime booms, social spending falls in real terms regardless of how the military expansion is financed, and public debt jumps by about 14% of GDP, nearly double the peacetime cost. So, if rearming is expensive, war makes no economic sense. That's what the IMF's third chapter devotes itself to. And the answer goes beyond the destruction of physical and human capital or what the reallocation of the productive capacity that survives towards military uses does. For one, private investment collapses almost immediately in conflict site economies. Even if a factory is standing and functional, its owner stops expanding it because they can't be sure their assets, their workforce, or the government itself will exist in the same form next year. Uncertainty is one of the most powerful forces in wartime economics, and crucially, it operates independently of physical destruction. You don't need your city to be bombed for investment to stop. The expectation of instability is enough. Then the fiscal situation deteriorates. Military outlays surge, but at the same time, the government's ability to collect taxes weakens as economic activity contracts, administrative capacity erodes, and more of the economy moves into informality. Total government consumption can look stable on paper, But what that usually means is that defense is quietly crowding out everything else. Now, the external sector breaks down in an asymmetric way. Exports fall harder than imports, war damages the domestic production base, disrupts trade routes, and causes importing countries to shift their sourcing away, sometimes permanently. Even foreign investment pulls back sharply, and the government is left with a shrinking set of external financing options: diaspora remittances, foreign aid, and very little else. All of this eventually hits the currency as foreign exchange reserves drain down. Governments with flexible exchange rates see their currencies depreciate, while those with fixed rates face pressure to devalue. Either way, depreciation feeds back into inflation, which is already running hot from the supply disruption. And governments usually respond by imposing capital controls, restricting how much money can leave the country. Now, for the average conflict site economy, the IMF estimates that output falls approximately 3% immediately at the start of a conflict and reaches cumulative losses of around 7% over 5 years. These losses are larger and more persistent than those from banking crises, currency crises, sovereign debt defaults, or major natural disasters. Now, the losses don't stop when the fighting does either. Output deficits persist even a decade after conflict begins. Capital stock is about 4% lower in 5 years in. And of course, the harms go beyond macroeconomic scars. Individual health data from 41 countries shows lasting damage to cognitive ability, physical health, and mental well-being in people who lived through war. Countries not involved in the fighting are not immune either. Neighbouring economies and major trading partners of conflict site countries see output fall by around 1% in the first 2 years as trade routes disrupt and regional uncertainty suppresses investment. These effects eventually fade, but they fall on countries that had no say in starting the fight. Once a war ends, the natural assumption is that rebuilding begins. Investment floods back, reconstruction creates a boom, and within a decade or so, the country recovers. But as per the IMF's data, that's almost too fantastical a story. To begin with, peace itself frequently doesn't hold. In about 40% of post-WW2 post-conflict episodes, countries relapsed into conflict within 5 years of the fighting ending. In those cases, the economy didn't even have a base to rebuild on because the conflict resumed before any new foundation could be laid. When peace does hold, recovery takes place, but modestly. Output begins to rise, reaching about 3.9% above end of conflict levels 5 years later. The problem is that this starts from a substantially lower base. A country that lost 7% of output during the conflict and then recovers 4% of that loss is still far below where it would have been without a war. Most of the recovery that does exist is almost entirely driven by labor. After all, workers come back from displacement, soldiers return to civilian life, and refugees trickle home. So labor supply recovers relatively quickly. But capital barely comes back, and neither does productivity. Investors remain cautious about committing money to a country where peace feels uncertain. So firms do something rational but economically limiting. They substitute toward labor and away from capital. Hiring workers is cheaper and more reversible than building factories. The result is an economy with more people working but not more efficient. The same tools, the same infrastructure, just more hands. And this is why post-conflict recoveries can look statistically reasonable while feeling hollow on the ground. But some countries have broken this pattern, and the IMF looks closely at how. Rwanda is the extreme case. The 1994 genocide caused GDP to fall 42%, while inflation also reached 42%. Within a decade, though, growth had recovered to 6 to 9% annually, and inflation was back at 2%. The recovery was built on several things happening at once. Donor-financed imports that immediately suppressed inflation by relieving shortages, comprehensive debt restructuring, a rebuilt National Revenue Authority, radical anti-corruption reform, and so on. Bosnia, Cambodia, and Cote d'Ivoire show similar patterns at different scales. Now, the IMF is not in the business of predicting which wars come next, but it is in the business of reading macroeconomic signals, and the signal embedded in this edition of the WEO is unusually direct. The world is producing more conflict and not less. The number of active wars is at its highest since 1945, and the economic costs are being distributed globally, even to countries that aren't fighting. The countries most exposed to conflict are also, almost by definition, the least equipped to implement the policies that make recovery possible. The conflict trap the IMF documents, where fragile peace collapses back into war before any stabilization can take hold, is not a failure of knowledge. The policy toolkit is reasonably well understood. It is a failure of institutional capacity, political will, and the near impossibility of making good, long run decisions in the middle of a crisis. That gap between what works and what countries can actually deliver is what makes war so economically catastrophic and so hard to come back from. Now, coming to the tidbits. Hindustan Zinc reported a 67.6% year-on-year jump in Q4 profit to Rs 5,033 crore and 49% revenue growth driven by higher metal prices and strong production. The company also announced a Rs 11 per share interim dividend of approximately 550%, marking a record performance across key metrics. Coming to the next tidbit. India and New Zealand will sign a free trade agreement on April 27th, aiming to double trade to $5 billion in 5 years. The deal will offer tariff-free access for Indian goods and open opportunities across sectors like textiles, pharma, and services. Coming to the final tidbit. Bharti Group is in talks to sell up to 85% stake in its life insurance unit to Prudential PLC for about Rs 7,000 to 8,000 crore. The deal would mark Bharti's exit from life insurance while helping Prudential expand in India's growing market. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.